Okay, next we will turn to the third type of strategies that involves options, which are spreads. Now, spreads, they are trading strategies that involves taking positions in two or more options of the same type. So, for example, you enter into two or more calls or two or more puts. So what's key about spreads is that they involve entering into the same type of options. Now, when you create a spread, all terms of the two options are the same except either the strike price or the time to maturity. So if you enter into a spread of call options, two or more call options, all terms of the call options will have the same underlying asset, same time to expire, could be time to expiration, same of course volatility because it's the same underlying asset, and same expected dividend payments. The only thing that will be different is the exercise price, or we will enter into two options, call options with the same strike price, same underlying asset. The only thing that will be different is the time to expiration. Now, when we are going to analyze spreads, we need to ask ourselves, what is the assumption that motivates an investor to create that particular spread? And the assumptions are basically about what is the investor's expected movement in the stock price and what is the investor's expectation about the volatility of the underlying stock. Now, once we created the rationale behind each strategy, we also need to ask ourselves whether the particular spread that we are dealing with requires from us to make an initial investment, so we have to pay cash, or there will be a margin requirement because we are receiving cash. So let's examine the first type of spread, which is a bull spread. Now, we create a bull spread using calls by doing the following. So at the beginning, we take a long position at a strike price K1 in a call option, and then we will take a short position in a call option with a strike price K2. Type. What do we notice? The combined profit for the bull spread is represented by the red line. So we observe that after the strike price K1, the profit increases as the stock price increases. And once we reach the strike price K2, in which we took a short position, the payoff will be flat, or the profit will be flat. So no matter how high the price goes, always our profit will be the same. Now, what motivates an investor to create a bull spread? Well, to answer this question, we need to look at when this spread is going to be profitable. Now, we notice that the spread is profitable when we move from K1 up to K2. So at K1 it was, we will incur a loss if the option expired when ST is equal to K1. As the underlying stock price increases, the profit we will generate or we will realize will increase until we reach K2. So compared to only taking a long position with the strike price K1. what do you think is the benefit of this strategy, and what do you think is the disadvantage of this strategy? Well, to answer this question, we need to look at how much it will cost us to create the bull spread. So the bull spread is equal to the call option with the strike price K1, since it's going to take a long in this in the call option with the strike price K1, and then we will receive the premium for the call option with the strike price K2. Now, by just comparing the cost of the bull spread with the cost of the call with the strike price K1, which one will cost us more? Obviously, it's the call option with the strike price K1. So an advantage of creating the bull spread is that we are going to realize, or we are going to pay a lower cost for constructing the spread. Okay, then what's the disadvantage? The disadvantage is if the stock price, when the option ended up at any price higher than K2, my profit from the bull spread will be always flat. If the price, now we compare this with the case when I just take a long in the call option. Well, the long in the call option, what's the maximum profit? It's unlimited. So we are sacrificing the upside potential for the sake of paying a lower cost. Now, when it makes sense to create the bull spread, if we believe that the volatility of the underlying stock is going to be high or low, well, here I can see that I will only make a profit if there is a low. I will maximize my profit if there is a low volatility. If there's a high volatility, then if I expect that there is a high volatility, then there will be no rationale behind me creating the bull spread. I should just buy a call option and that's it, because it will buying a call option will increase the probability that I will gain a higher profit. But if I believe the volatility is going to be low, then it's better just to create the bull spread to minimize the cost of entering into the spread, and since exactly we want to minimize the cost of the spread. Now, so to create the bull spread, the investor must expect that the volatility is low. So that's for the investor's expectation about the volatility. How about the direction of the underlying stock price movement? Is it going to increase or going to decrease? Well, see here that the becomes profitable when we move from K1 to K2, which means that the the price of the underlying stock is increasing. So assumptions. Let me write it in the board. So the major two assumptions for the bull spread is that the volatility of the underlying stock is low, and the movement of the stock price is increasing. It's going upwards. Now, we concluded the discussion of the bull spread by asking ourselves, are we going to make a market requirement, or there will be an initial investment? Well, we have to look at what is the net of creating the bull spread. Is it a cash outflow from my pocket, or I'm going to receive a cash? To answer this, we need to see the difference between the call option with the strike price K1 and the call option with the strike price K2. Is it positive or negative? Well, we have to remind ourselves when we learned about chapter 11. The call option with the strike price K1 is greater or lower than the call option with the strike price K2. Now, what's the relationship between the call option price and the strike price? Is it positive or it's negative? And if you remember, the intrinsic value for a call option is equal to the maximum between minus K and 0. So when we increase K, what will happen to the intrinsic value? It becomes smaller. And if it becomes smaller, what will happen to the option? It will become smaller. So which one is greater than the other? The call option with the strike price K1 or the call option with the strike price K2? Obviously, call option with the strike price K1 is higher. So if I am paying the call option with the strike price K1 and I'm receiving the call option with the strike price K2, so it is cash out, right? If that's the case, it means I'm required to make an initial investment to create a bull spread. So we add here that will require an initial. So we put it here as an addition that the bull spread will require an initial investment because the call option, the strike price K1 is greater than the call option strike price K2. Okay. Now, another way to analyze the payoff of the different spreads is that we will look at what will be the payoff of each option in the spread at different stock price ranges. So since we have two strike prices, it means we have three ranges. The first range is when ST is lower than K1. In this case, both the long call and the short call are out of the money, which means the payoff will equal to 0. If ST is greater than K1 but is lower than K2, then only the long call will be in the money, which means the payoff will be ST minus K1, and the payoff of the short will be out of the money, so the total payoff will be ST minus K1. If ST is greater than K2, then the payoff from the long call is the same, ST minus K1. The payoff of the short call is the negative because I am making the payment, I am paying the payoff minus ST minus K2. Now, open the bracket, then minus times ST will be minus ST, and minus times minus K2 will give us plus K2. So ST minus K1 minus ST plus K2 will lead us to have a total of K2 minus K1. Okay. Now, which of the following bull spreads you think is the most aggressive? When here we have three scenarios: when both calls are initially out of the money, or when one call is initially in the money and the other is out, and when both calls are initially in the money. So what we are saying here is, which one you think is the most aggressive? Is the option when we create a bull spread where both options, so let's assume that we are dealing the stock price was here, which means K1 and K2 are lower than ST, which means that both are in the money. This is an aggressive strategy. Now here there is nothing concerning. I don't need a large movement in the stock price to realize the payoff of the spread, right? Since when we are approaching the maturity, both are money, then there is no need to worry about whether the option is going to be exercised or no. Now, the other scenario is when T is here. So do you think this is an aggressive strategy, which means you require a large movement in the stock price to realize a profit? Well, the answer is also no. Why? Because K1 is in the money, but K2 is out of the money. So still you are making a profit. Now you would like the profit to increase, but you need a large movement in the underlying stock to be able to create a profit. The third strategy is assuming that both options are out of the money, which is a case when, let's say, ST is here. So both options are out of the money, and if you created such a strategy, you are aggressive in the sense that you expect the stock price will move in a magnitude, because you require a large in the underlying stock before you can make a profit, right? If it is in this region and it expired in this region, then you just wasted your money. You paid the premium and you did not receive any profit, right? So that's why we will consider both calls are out of the money to be the most aggressive strategy. Now, any spread that we can create using calls, we can also create using puts. Okay, so we can also create a bull spread using put options. How can we do this? Well, we will do the following. First, we will short a put option with the strike price K2. So, put option with the strike price K2, we will take short. And the put option with the strike price K1, we will take a long. Long put option with the strike price K1. Now, do you think the underlying assumptions about the bull spread using puts will be different from the bull spread using calls? Do we expect the volatility to be higher or low? And if you look here, the strategy will be profitable. Volatility was in this region, which means we don't expect there will be a high volatility. We expect the volatility will be low. What else do we expect? Do we expect the stock price is going to increase or is going to decrease? Well, the only way my profit will I will start making profit and my profit will increase if the price of the stock increased. Of course, don't expect there will be a large movement in the stock. I believe the stock will increase to be closer to K2. So now we ask ourselves, if we create a bull spread using put options, do we need to make an initial investment, or do we need to make a margin requirement? Well, the answer to this question depends on what is the relationship between the put option with the strike price K1 and the put option with the strike K2. And to determine the relationship between these two prices, we need to remind ourselves with the intrinsic value, which equals to the maximum of S minus T. Sorry, no, this is not correct. So it's the maximum between K and S and ST, or 0. Now, if we increase the strike price, what will happen to the put option price? Well, if K increased, the intrinsic value will increase, which will lead to the put option price to increase, which means which one is higher than the other? So the put option with the strike price K2 is greater than the put option with the strike price K1. And since we took a short in this put option, we took a long this put option, so net, are we going to receive cash or we are going to pay cash? We are going to receive cash, right? So it is similar to the case when I'm going to short options only. There is an exposure, again, there is a credit risk associated with me not being able to pay the payoff or exercise or meet the commitments in the put option. So there will be a margin requirement. Okay, now we summarize what we learned about the bull spread. In the case of bull spread using puts, also the volatility of the underlying is expected to be low and the price of the stock is increasing, and there will be a margin. The investor must maintain a margin requirement because the put option with the strike price K2 is greater than the put option with the strike price K1, because we are receiving this premium and paying this premium. Now we move to the next type of spread, which is called the bear spread. Now in a bear spread using put options, what do? I will take a long position in a put option with the strike price K2, and then I will take a long position in a put option with the strike price K1. So how this spread is different from just taking a long position in a put option? Well, to answer this question also we have to go back and remind ourselves what's the relationship between these two strike prices or options with these two strike prices. So we know that the put option with the strike price K2 is greater than the put option with the strike price K1. And we took a long here, and then we took a short here. So net, did we pay cash or did we receive cash? Well, the larger minus the smaller, net will be cash payment. So there will be a cash, an initial cash investment. Now, with respect to the volatility, what do we expect will volatility be for the underlying stock? High. Well, if we are creating the bull spread, again we are assuming that the volatility is low. Otherwise, if we believe that there will be a huge volatility, then we will just take a long put and that's it. So in terms of volatility, we expect volatility will be low. In terms of the direction of the underlying stock, do you believe the underlying stock price will increase or will decrease to justify creating this spread? Well, it will only turn to be profitable if the price of the stock decreased, right? But not beyond or below K1. So in sum, we expect that the underlying stock returns volatility is low, and we expect that the price of the stock will go down. So to summarize, the assumptions that motivate us to create a bear spread is that the volatility of the underlying stock is low. We expect the volatility of the underlying stock is low, and we expect the price of the stock is going to decrease, going to drop down. Of course, it will not drop down a lot. There will be a down movement in the stock price, but to a limited level. And creating a bear spread using put options will require from us an initial investment, because we paid for the put option with the strike price K2, and we received the premium for the put option with the strike price K1. So net, there will be a negative cash out of the company. Similar to the case of the bull spread, we can analyze the effect of the different stock price ranges on the total payoff of the spread. So if ST was lower than K1, which means the payoff of the put position, long put and the short put are both in the money, which means the payoff of the option will be for the long put option will be K2 minus ST. The payoff from the short put option will be minus K1 minus ST, because we are paying this payoff. Now, if we open the bracket, then minus K1 and minus times minus will give us plus ST. So plus ST and minus ST will cancel each other, and the total payoff will be K2 minus K1. If the underlying stock price is between K1 and K2, then the payoff of the only the long put option will be in the money, which means the payoff will be K2 minus ST. The other the short put option is out of the money, which means the total payoff will be K2 minus ST. When ST is greater than K2, both options are out of the money, and the total payoff will be 0. As what we did in the previous spread, in the bear spread we can also create it using calls, not only puts. So how we can create a bear spread using calls? Well, we take a long position in a call option with the strike price K2, and we will take a short position in a call option with the strike price K1. In terms of the underlying assumptions, it's the same. We expect a low volatility, and we expect the stock is going to go down. What's different here is whether there will be a margin requirement or there will be an initial investment. Well, to answer this question, we need to look at the call option, the strike price K1 relative to the call option with the strike price K2. And in K1 we took long, and in K2 we the call option with the stock price with the strike price K2 we are going to take a short. Now, what's the relationship between the strike price and the call option premium? Is positive or negative? Well, it's negative. It's negative, right? Which means the price of the call option with the strike price K1 is higher than the price of the call option with the strike price K2. Here I did a mix-up. The positions are the opposite, right? We took a long at K2 and we took short at K1. So here we have short. Here we have, which means what? Are we going to receive cash more than what we paid or less than what we paid? Well, since the option with the strike price K1 is larger, it is the case that I'm going to receive more than what I paid, so there will be a margin requirement. When you take a short position in an option, call or put, there is a margin requirement, and here it's not a different case. Since there is an exposure towards you not being able to meet your commitments, then there will be a margin requirement to minimize the credit risk. Now, the third step, the third spread is called the box spread. Box spread is basically a combination of a bull call spread and a bear put spread. Now, if the options are European, then basically we expect the box spread to be worth what? Well, first we have to look at what is the payoff of the box spread. So determine the payoff of the box spread, and the box spread consists of buying a call spread with strike price K1 and K2 and shorting a bear put spread with strike price K1 and K2. So that's what we mean with buy. So we buy or we enter into a long in the bull call spread and a long in a bear put spread, both with strike price K1 and K2. So if ST is less than K1, then the payoff from the bear put spread is K2 minus K1. Why? Because only the put options will be in the money. So, and we saw for the bear put spread that the payoff is K2 minus K1. If ST is between K1 and K2, then the payoff from the call bull spread is ST minus K1, and the payoff from the bear put spread is K2 minus ST. So net, the total payoff will be K2 minus K1. If ST greater than K2, then net K2 minus K1, that will be the total payoff from the bull call spread, and it will be also the total payoff of the box spread. What do we notice here? We notice that no matter how high or low the price will reach, we will always realize K2 minus K1. So if we created the box spread, is there an uncertainty about how much we will be receiving? We can see whether the price of the stock reach 0 or reach 1 million. Always the payoff is going to be K2 minus K1, which means this strategy is considered riskless. If it is considered riskless, then what should be the effort you guys need to put? What I'm saying, if the payoff is the same no matter how high or how low the price of the stock goes. Okay, so we will always realize at time t k2 minus k1. If that's the case, what is the discount rate we should use to find the price of the spread today? Well, since it's riskless, then the discount rate we should use is the risk-free rate. Then, to find the price of the box spread, we need to get the present value of the difference between the strike prices. However, this will only work if we are dealing with European options. If we are dealing with American options, then the situation is going to be different, because the spread will not be any more riskless, because there is the chance that for put options to be exercised. Right? If you remember from chapter 11, there is always a chance to exercise a put option early. But for call options, especially when the stocks do not pay dividends, it is optimal to wait until the maturity of the option. The final spread we will be covering is called the butterfly spread. Now, understanding the butterfly spread, or understanding how we create the butterfly spread, will help you create any other type of payoff structure. So let's examine how we created the butterfly spread. Well, now we are dealing with butterfly spread using call options. So at K1 we took a long position. Okay. At K2 we did something that moved the profit line from being increasing to be decreasing. Now, is it possible that at K2 we took one short position? Well, if we did one short position, it should look flat. Remember from the bull spread? One long at K1 and one short at K2. Now notice the effect of taking the short. It moved the profit line from being increasing to be flat. Okay? If that's the case, and we observe in the butterfly spread that the profit line is not increasing, it's not flat, it's decreasing. So what should I do? So we learned first that at K1 we will take long. At K2, what we will do? If we took, as I said, if we took one short, the profit line will move from being increasing to be only flat. So I need to take another short to move the profit line from being flat to be decreasing. So we will take two short call options with strike price K2. Okay, now if I did not do anything at K3, the profit line will be decreasing like this. But at K3 I did something that moved the profit line from being decreasing to be flat again. What did I do? Well, I took a long position with the strike price K3. Okay, again, we took one long position at strike price K1, so that will be increasing. As the stock price increase, the profit will increase. At K2, we are going to take 2 short call options. So the price now at K2, instead being increasing or flat, it's going to be decreasing. At K3, instead of doing nothing and make the profit decrease as the stock price increase, we took another long position in a call option. Yes, in a call option strike price K3. Okay, now comes the question. What is our expectation about the volatility of the underlying stock and the movement in the underlying stock that motivate us to create the butterfly spread? Well, to answer this question, we need to know when this strategy is profitable, right? It's profitable if only the volatility of the underlying stock is around K2, right? Otherwise, there will be a loss if the price is below K1, and if it is below K3, then there is there will be a loss. So the only scenario where we are going to make a profit if there is a low volatility. Do we have any expectations about the direction of the movement in the underlying stock? Here, no. We don't know, or we don't have any expectations about whether the price will increase or will decrease. But what we know for sure, or what motivates us to enter into a butterfly spread, is the volatility is going to be very low. Now, by just looking at the butterfly spread profit, do you think the butterfly spread will require an initial investment, or it will require a margin requirement? Well, if the options are out of the money, do we realize a net profit, or we will realize a net loss? Well, if all the options are out of the money, expired out of the money, then we will realize a net loss, which means that to create a butterfly spread, usually it requires an initial investment. So to summarize the assumptions about the butterfly spread, or that motivate us to create a butterfly spread, is basically that we expect the volatility of the underlying stock to be very low, around K2, revolving around K2, and we don't have any expectations about the direction of the stock price. And we also agreed that the initial this strategy will require an initial investment. Now we can create what's called a short butterfly spread. Now the short butterfly spread is the opposite of the butterfly spread. So to create a short butterfly spread using call options, we will take a short at strike price K1, then we'll take 2 long in a call option with the strike price K2, and we will end with 1 short with the strike price K3. So 1 short, and we will take 1 long to move the profit line from being decreasing to be flat, and another long will move the profit line from being flat to be increasing, as we see here. And then instead of the profit line being increasing to infinity, we take 1 short to move the profit line from being increasing to be flat again. As we said initially, you can create a butterfly spread using puts also. So any spread we can create using calls, we can also create it using puts. So how can we create the butterflies spread using put options? Well, we will take a long position in an option, put option with the strike price K3. At K2 we will take two short put options. K1 we will take one long put option, and we will get the same profit diagram that we saw earlier. The assumptions will not be different. The cost also is going to be similar. There will be an requirement for initial investment, and our expectation about the volatility and the direction of the underlying stock price is going to be the same. So we believe that volatility will be very low around K2, and we cannot, we do not have any expectation about whether the price will go up or it will go down. Now, finally, we will examine the last type of spread that we will be covering, which is a calendar spread. Now, in a calendar spread, it involves entering into two options that have the same underlying asset. Okay, same strike price. So since they have the same underlying, they have also the same volatility, expected volatility. Both will have the same risk-free rate. Both will have the same expected dividends on the underlying stock. So the only thing that they are different is different time to expiration. So how can we create the calendar spread? Well, we create the calendar spread by taking a long in a call option with to expiration T2, and we take a short in a call option with the time to expiration T1. Such that if we examine the timeline, we will find that T2 is greater than T1. Okay, the question is, when we create a calendar spread, we are betting on what? Now, if they both have the same strike price, do they have a different intrinsic value? So, intrinsic value equal to the maximum between S T minus K 0. S, the underlying stock price, is the same. K also is the same. Both they have the same strike price. So the intrinsic value is not going to be different. What is going to be different is only the time value. So option price is equal to the intrinsic value plus the time value. Now, if both options have the same intrinsic value, then should we expect they will have the same time value? Well, one has a time to expiration, that's T1, and the other has a time to expiration, T2. And what we will do, now we took a long in a call option with the time to expiration T1, and a short with the time expiration long in T2 and short in T1. And once we approach T1, then it's time to either exercise or the option will expire worthless. And we are going to also close our position in the long option. Now when we reach time T1, what's the time value for that option, for the option in which we took a short? It's going to be 0. How about the option that has the time to expiration T2? There is still time left, so we expect at least that there will be some time value component for that option, which means when I'm going to close my position, my time value should be a little bit positive. Now, the strength or the magnitude of the time value also depends on the moneyness of the option. If the option was deep in the or deep out of the money, then usually the intensity of trading will be very low, which will make the time value component very small. So we will not be able to cover the cost of initiating the calendar spread, and we will incur a loss. When the price is closer to be at the money, closer to the at the money range, this is where the trading will be intense. Now it is like when you are matching a soccer game, for example, Hilal and Nasr, or Milan and Manchester United, and the results of the match is 1-1. Do you think this match is going to be more intense? Well, it is where the fans are anxious and worried who is going to win the match, or if, for example, the results of the game was 5-0 for one of the soccer teams. Well, when it is 5-0, then almost the winners are almost certain that they are going to win. The losers are almost certain that they lost the match. But when the results of the match is 1-1, here where everyone is just waiting anxiously, who is going to win? Is any team going to score a goal before the end of the game's time? The same applies on options. When the option is approaching its expiration date and it's closer to the at the money region, the intensity of the trading will be high, which will drive the time value to be high. So when I am going to close my position in the long option that will expire at time T2, when I'm at T1, if the time is large enough, then I will retrieve the cost of setting up the calendar spread, and I will also make an additional profit for myself. So basically, the calendar spread is betting on the time value component of the option, because the intrinsic value will be the same for the long and the short. We can create the same calendar spread using also put options by taking a long in a put option with the time to expiration T2, and we will take a short in a put option with time to expiration T1. And once we reach time T1, we will close also our position in the long put option, and hopefully our expectations that the volatility of the underlying stock is around K2 prove to be correct, and in this case we will make a profit.